literally a macro power map with the Treasury, the Fed, stablecoins, and Bitcoin at the center of it all, right? So markets at the end of the day don't just move on policy statements, right? They actually move on incentives. That is why crypto investors at the end of the day should pay close attention to the new macro power map forming around Scott Bessent, Kevin Walsh, and the broader Druckenmiller linked global macro network. I think a lot of people like to look at charts and technical analysis and things like that. But I think these are some of the most overlooked nuances, because at the end of the day, behind the policies, behind all of these shifts are real human beings that have real interest as well. And no human being is immune to self-interest in some kind of way, right? You wouldn't detonate an arsenal that will decimate your own portfolio, right? So the thesis is that, policy is not secretly controlled by one group. The thesis is much simpler. Powerful people make decisions inside of networks of capital, beliefs, relationships, and balance sheets at the end of the day, and those incentives definitely do matter. Bessent, like I said, brings a macro trader's worldview to the Treasury. His framework points towards stable coins as digital dollar rails. The Treasury bill demand as a funding tool, energy-led supply expansion, the Bitcoin strategic reserve as an asset. This is their theory, and these are the things that we need to really be thinking about, the people that are making really important decisions about where the global economy is going to go. Walsh brings a Fed framework that increasingly ties itself to AI productivity narratives, disinflationary growth, and rate normalization. We'll see how that all pans out. But if AI allows growth without the same inflation pressure, I think the Fed has more room to cut. That matters for every liquidity sensitive asset, especially Bitcoin, right? Bitcoin benefits from lower rates and reserve legitimacy, and also stablecoins benefit from regulatory clarity and treasury demand. DeFi benefits from traditional yields fall when those yields fall, and stablecoin collateral becomes more trusted in AI, and growth stocks benefit from lower discount rates as well. Gold benefiting from the same debasement concerns that support Bitcoin.